People don't understand their natural advantages, and they don't use them. That's bad, number one.
Everyone is getting it completely wrong when it comes to investing. Conventional investing wisdom states that the average person doesn't stand a chance against the pros on Wall Street. However, believe it or not, the individual investor has a massive advantage over professional investors. This is coming from none other than legendary investor Peter Lynch. Here are 5 most significant tips for investing in small amounts. Let's get into it. Number 1. Know what you own and know why you own it. Never invest in an idea you can't explain in crayon. According to Peter Lynch, the basic rule of investing is to understand what you own and why you own it. He strongly believes that investors can invest successfully if they are well aware of the company, its business model, and its fundamentals. As an investor, researching stocks and the companies that offer them will help you think wisely and make the right decisions when it comes to your investments and returns. This means that if you own a stock, you need to have a deep understanding of the company, its products, and what sets it apart from its competitors. Additionally, you need to be able to explain to your child why you own the stock. That's why Peter Lynch's advice to know what you own seems even more relevant today. Lynch believed that if he couldn't explain what a company does in less than 30 seconds, he shouldn't own it. The same applies to any investment opportunity. Whether it's stocks, bonds, insurance, mutual funds, or other financial products, you should only invest your money if you fully understand how they work and the risks. You won't become a millionaire overnight, but you'll be able to make a solid profit and sleep peacefully at night. The second part of the advice, understand why you own it, is equally important. By aligning your investments wisely with the financial goals you want to achieve, you can avoid the mistakes of impulsive investing. Because you know that if you stop investing, you'll never reach your goals. This disciplined mindset will help you navigate adverse market movements and become a better investor. Number 2. Look beyond what is visible. Peter Lynch once said, "During the gold rush, most would-be miners lost money, but those who sold them picks, shovels, tents, and blue jeans made handsome profits." He said it correctly. Do not operate on the internet in a way that indirectly benefits from internet traffic. Alternatively, you can invest in a manufacturer of switches and related equipment to keep your traffic moving. As an investor, it's important to think outside the box. Promising stock ideas are available and visible, but other companies are also working to support this stock rally. For example, if you see a particular company's stock doing well in the market, it will be obvious to everyone. But beyond that, you should look at other companies and retailers that have contributed to this stock's success in e-commerce, retail, hardware, and more. Investing in them can turn out to be profitable. However, it is important to do your research before investing. Number 3. Let your winners run. Let your winners run and cut your losers. It's easy to make a mistake and do the opposite, pulling out the flowers and watering the weeds. Lynch invested in a variety of stocks throughout his life. Some of his investments have performed mediocrely, others have performed well, and some have yielded amazing returns. What helped him achieve exceptional returns throughout his career was sticking with top performers rather than building on his gains after short-term rises. He coined the term 10-bagger to describe a stock whose value increases by 10 times his or 1,000%. His first rule in finding 10-baggers was to not sell stocks until the fundamentals changed. He would continue to hold these stocks even if their prices rose 40% or even 100%. Mr. Lynch said, "The lesson here is to be patient with the best performing investments." Many investors feel the urge to lock in their profits after making enough money in a year from a mutual fund, even if they're far from their financial goals. As a result, you miss out on the opportunity to harness the power of compound interest to generate exponential profits and achieve your financial goals. Yes, profit booking makes sense, but only if you use it to rebalance your portfolio based on your asset allocation. Suppose in the portfolio, he decides to include 70% stocks and 30 BTG. After the stock market recovery, the proportion of stocks in the portfolio increased to 80%. In this case, you can book gains on equity investments and reinvest those amounts in debt to ensure that your portfolio is not biased toward any particular asset class. Number 4. Invest for long term. One of Peter Lynch's many trusted pieces of advice is that long-term investing yields higher returns. He once said, "Without many surprises, stock prices are relatively predictable over a 10 to 20-year period. You might as well flip a coin to decide whether stocks will go up or down in 2 or 3 years." He didn't invest or sell anything until he felt the time was right. Furthermore, Peter Lynch did not attempt to predict the direction of the overall market economy in order to decide when to sell stocks. He strongly believes that predicting short-term market fluctuations is not worth the time or effort. If the company you invest in is strong, its value will increase over time. So he spent time figuring out what the actual need was and finding great companies to invest in. Number 5. Accept periodic losses to win in the long run. People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game. Like most successful investors, Lynch believes that investing for the long term is critical to investment success. He advised that to achieve long-term success as an investor, you should avoid 2 emotional states: 1 concern and 2 surrender. The first concern status occurs after the market experiences a sharp correction. There is a unique opportunity to benefit from this adjustment at this time. However, concerns prevent us from buying good investment opportunities at bargain prices. The next emotional state, surrender, occurs when a market correction reduces investment. Lynch points out that many investors consider themselves long-term investors, but only until the next big decline, and they quickly become short-term investors and sell at huge losses. Let's understand how this applies well with an example. Suppose you have invested about 15 years ago on April 1, 2006, $100,000 on Sensex. If he had maintained this rate for the entire 15 years, his investment would have increased to Rs 4.32 million at an average annual interest rate of 10.3%. On the other hand, if you had sold after the sharp correction in 2020, your potential return would have been reduced to Rs 2.44 million. In fact, if you sell after the 2009 revision, you will lose your original investment of Rs 100,000. The lesson here is clear. To get big profits in the long run, you have to accept regular losses. In Lynch's words, a catastrophic collapse shouldn't get you kicked out of the game. The trick is not to trust your intuition, but to discipline yourself to ignore it. Losses may occur. As an investor, don't just expect success. Losses are inevitable. Peter Lynch once said that in this business, if you're good, you'll be right 6 out of 10 times. 9 times out of 10, you're never right. Here is one exclusive bonus tip by Lynch for you. Enter early, but not too early. I often think of investing in growth companies in terms of baseball. If you buy before the lineup is announced, you're taking an unnecessary risk. Lynch advises investing in opportunities early to avoid taking unnecessary risks. He thinks it's similar to betting on a baseball team before the lineup is announced. It is always better to use a proven and existing system than to choose something new or unpredictable. That's all for today. What do you think investors can take Mr. Lynch's advice seriously and gain high returns? Do comment on your thoughts, and do hit the like button. For more investing tips and tricks, subscribe. See you